All right, welcome everyone. Good morning. Good morning. We'll put up the chat there so you can drop a comment. I see some people are already dropping comments as well. We'll wait a few minutes here to get started. Give everybody a chance to jump on. Let us go live on all the different platforms. Hope everyone's been having a great week. Good morning. Good morning. Those that just jumped on, just hang tight for a second. We're just waiting to go live on all the different platforms and let everybody have a chance to jump on. All right, looks like we are good to go. So we can go ahead and get into it here. We'll go ahead and take the chat off the screen and we will get it going. So welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche. And we are going to go through the live rates. So every morning we pull up the live rates for the different programs so we can show how the rates are going up and down and see how the market is reacting on a daily basis. So after that, we always do a deep dive into a different topic. And today's specific topic that we're going to go into is one-time close construction loans. So we'll get into that after we pull up the rates. But before we do that, Nick, let's do how we do every morning, pull up our pricing tool and get into the actual live rates for today.
All right, let's get started. Let me switch my screen and pull up the tool. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate with all the detailed cost breakdown, please reach out to our team. We'd be happy to provide that. We have over 300 loan officers and are licensed in 22 states for primary and second homes. And we can do our investor DSCR business purpose loans that we love to do in pretty much all states. So a lot of great opportunities there. This tool is just going to show us the rates and APR for today. It is March 29th, just after 11 a.m. Eastern. So our standard programs have rates issued for today. So we're going to set up a few scenarios. For all of our scenarios today, we'll use a nice easy 400,000 loan amount. We'll use a loan to value of 80%. That means 20% down payment, 80% loan. We will tell the computer to find the best rate at a 99 price. That means one discount point in cost. Most of our clients are asking to buy down the rate a little bit. So we will typically set that at one discount point in cost. We're going to do a demo on our conforming conventional programs. Then we'll go into FHA, which is usually the next best option with a little more lenient guidelines. Then we'll go into our non-QM or expanded guidelines where we have over 5,000 loan programs that use alternative income and all kinds of different guideline variations. We won't do our VA or USDA. Remember, VA is only for our eligible veterans. We do appreciate your service and would be happy to quote it, but since not everybody is an eligible vet, we don't do that live. And same with USDA, that's only for eligible property in a USDA eligible rural area. So if you are shopping, we'd be happy to quote that as well. But let's start with our conforming conventional. We're going to do purchase, 30-year fixed loan, standard loan, primary occupancy, single family, one unit, nice and easy. State of Florida, County Miami-Dade, that's where our office is. And for all of our demos, we'll use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So let's check out our rates this morning. So nothing really major changed. I believe this is nearly identical to yesterday. So again, we're kind of at a standstill here. Not too much variation than the last week, but this is good. This is lower than it's been for quite a while. 6.5 rate for one discount point in cost for a final APR of 6.676 for our conforming loans here for this example. So remember this APR, we're always going to use APR to compare across programs, which includes all of the costs of borrowing. So we see here conventional, we're at 6.676. And next we'll pull up FHA Typically, FHA is the next option that we present to a borrower that may have a challenge or any reason to not meet the conforming guidelines. FHA does have a little more leniency on credit and, of course, a higher debt to income ratio we can use. So typically that's our next option. So let's check out our FHA rates. Everything else will keep the same in this example. So FHA is obviously a little bit lower rates. Typically, most people realize that. Let's see if, yep, this looks like the best combo here. 5.75 rate for 1 discount point in cost for a final APR of 6.352. So when you compare that to conventional, a little lower APR. So therefore, the FHA is a little more viable in this case for this scenario. So always want to compare FHA, even though FHA does include upfront mortgage insurance and yearly mortgage insurance. Those have been lowered a little bit, and those are factored into the APR, so you can compare it across the programs. So FHA is amazing right now. Definitely recommend everybody takes a look. Now for our final primary home example, we'll set up the same scenario. Many other banks and lenders don't have any other options once you go through their conforming and FHA options. Fortunately, at the mortgage calculator, that's where we specialize, is we have over 5,000 loan programs under expanded guidelines where we can use alternative income and a bunch of other guideline variations. So a lot of different options under this umbrella. We'll keep everything else the same, but you see now we have our new option that pops up where we can change our income verification. So full documentation, that's 2 years of tax returns. So that's what we use for FHA and conventional loans, what most people are used to. So that would kind of defeat the purpose. Usually we pick a non-QM program to use alternative income. So we have programs for 1 year alternative income, 2 year alternative income. We can use assets, which we've done a few shows on. Check those out. We can use business bank statements. We can do our DSCR program, which we'll talk about in a minute. But our most popular program by far for our non-QM alternative income is going to be our personal bank statement 12-month program. That's going to be for our self-employed borrowers. Many self-employed borrowers, when they have 2 years of tax returns, have various write-offs and for other reasons may not quite meet the debt to income ratios we need to meet. So we're simply going to use 12 months of bank statements, not their tax returns, to determine their debt to income ratio based on their actual cash in the bank. So many times we can qualify borrowers for much more income using these methods and therefore can qualify a borrower where they would not otherwise qualify. Or if they need to qualify for more income and therefore a higher loan amount, we can use these alternative income methods. So typically we'll use these non-QM programs where someone may be stuck or unable to attain the home of their dreams using the regular methods. So let's check these rates out. They are going to be a little bit higher because these non-QM programs are going to be always going to be a little bit higher, but very viable options. So you see here the best option we have, the computer's finding, is a 7.375 rate for 0.875 discount point in cost and a final APR of 7.418. So remember, conventional was in the high sixes on the APR and the FHA was in the low sixes on the APR. So the alternative income using bank statements being in the low sevens, very comparable. Sometimes they're a little bit further apart, but right now, those three options are very much in line. So I definitely recommend for our loan officers out there, definitely recommend you quote your customers all three different options. Let them compare which may suit them best. And for the borrowers out there watching, make sure you guys check out FHA and bank statement options. They're very comparable in price and fees and all of that. And many times we can make a borrower's dream come true by using alternative income and qualifying them for more income and therefore a higher loan amount and get that home they've always wanted. Now, let's go into our final demos here. We always want to check out our investment property rates. So we love to work with investors here at the Mortgage Calculator. So we'll set this to investment, whether they're first-time investors and getting their first rental property. Many people are looking to Airbnbs right now and stuff like that. So we love to work with those, as well as very seasoned investors with hundreds of properties. So we'll check out our options for investment properties. We'll set the scenario the same, 80% loan to value, 20% down payment for an investment property. And we're going to compare our conventional conforming loan programs with our expanded guidelines. Remember, FHA, VA, USDA, not eligible for investment properties. So we'll just compare our two examples here. So we'll start with conforming conventional. Keep everything the same, purchase 30-year fixed, everything the same as our scenarios before. Let's check out what investment property rates do here. So as we say every morning, remember that the conventional loan programs have added price adjustments to investment properties to kind of deter investors from using these programs. So unfortunately, the computer's unable to find a one discount point cost option. So the best option here for APR wise, remember we always compare APR, is a 6.875 rate for 3.5 discount points and costs, which is a 7.135 APR. So remember, these programs, unfortunately, we can't go higher in rate to really lower these discount points. Many times our investors that are seasoned investors would rather deploy this $14,000 here in this example of discount points and costs in another investment. So that's where we love to present our non-QM options as well. And just for an example here, I'll cruise down the chart a little bit and we'll see even if an investor wants to go higher in rate, like a 7.5 rate here that we have, for 2.75 discount points, really doesn't save them enough out of pocket to really make a difference. And you see the higher APR there. So we love to present our non-QM options so they can compare them side by side. So let's cruise over to our pricer for the final demo today. And we will select, set up the same scenario, select investment property. And our final example will be our expanded guidelines non-QM programs. And we'll see that two new options pop up that we have to set here. So first, we need to set our income verification for our non-QM program. And our most popular option by far is our investor DSCR program. And that is because it does not actually require any income verification from the borrower and no employment information from the borrower either. We're simply going to use the estimated rental income from the property in order to offset the PITIA, the mortgage expenses of that property. So typically, if the rents can cover those expenses, that's a ratio over 1 DSCR. So we have tons of options for that you'll see in a second. We also have options if a property doesn't quite cash flow to pay the mortgage payment. There's still options for DSCR ratios under 1. So tons of different options here. Please get with our team to find which one fits best. But we're going to check out our basic scenario here. The other option we have to set is our prepayment penalty. Prepayment penalties are standard on non-QM investment properties. We can select 0. That will limit our loan programs and also cost more. So typically we're always going to choose 3 years. That's the most standard. And we can choose 5 years if we want to save a little bit of money. That'll be a little cheaper, but many investors don't want a 5-year prepay. So 3 years is the most standard option. So as we do every morning, we will set that up. And let's check out our DSCR rates this morning. So it went up a little bit. We had a few other options in the 7s yesterday. So definitely recommend our investors jump on these products today. But right now, the best option the computer found, 7.99 rate for 0.475 discount points, very low discount points. So our investors here are going to be happy. Less money out of pocket. They can deploy on other investments. And a final APR of just over 8%, 8.020. So remember the conventional examples was in the high 7s, and here we're in the low 8s. So very comparable right now to compare the conventional investment properties with the DSCR, especially when you consider DSCR doesn't require any documentation from the borrower, and we can also do multiples. So our investors with multiple properties many times will cash out multiple investment properties with the DSCR program to purchase multiples at the same time. And we can start 2, 3, 5, 10 loans at the same time because they're not relying on the borrower's income and employment documentation. So these programs are amazing. And as I said before, there's a ton of different flavors and versions with different DSCR ratios you can see here. So I know this is confusing for anybody out there watching, but please get with our team. They'll navigate which one of these options fits best for you. You might find some here at the higher rates. May allow things like short-term rental income. So if you have a specific scenario, please get with our team and they will navigate this for you. Just tons of different options here that you can see. And that's why we love to offer these for our investors. So let me get into the detailed example. So give me 1 second. Let me switch my screens up. And pull up my example. And pull up my topic here. I'm going to zoom in so we can see it. And all right. So today's topic is going to be one-time close construction loan. So what do we mean by that? That is a loan where a borrower, this is going to be for a primary home. This is not for an investment property, right? We're talking about primary homes, one-time close construction. The other day we were talking about ground up and fix and flip for investors. This is for somebody looking to build a primary home. This is going to allow that borrower to purchase a plot of land and build the entire home from ground up, from scratch, and deliver that home to the borrower with an end loan. So all of the purchase of the land, all of the construction, as well as the 30-year fixed loan is going to be all inclusive in this product. These are great products for our borrowers. They can lock in their dream home, get sometimes, for example, pre-packaged plans from different developers and builders and stuff like that, and really easily execute a build of their own, right? Where they don't have to buy a pre-existing home, can customize it to their own liking, and can basically, it's limitless there, right? They can add, pools and other features, things like that, which may be prohibitive if you're buying an already existing home, especially with the housing crisis that we're facing right now. With a lot of low inventory, this is a great solution for our borrowers that qualify. Obviously, this does have higher credit qualifications and other things that we'll talk about here in a second. But if a borrower does qualify, this is a great solution, especially with the limited inventory that we have at this time. So again, one-time close construction is one close, one loan for purchase of land, building an entire home, typically 12 to 18 months build time for the actual construction of the loan, construction of the home, sorry. And then it's still a 30-year fixed loan. So it's the end loan for the whole thing once it's done. And what you get, of course, is a brand new home delivered to you brand new. And you get the lock in the loan right now in order to know what you're at in 1 year when you're actually going to move into that home. So great options here. They are a little bit complicated. So please get with our team. Our team is happy to consult our borrowers through this process. But let me go ahead and pull up my example here. So let me switch the screen one more time. And since Jose's not here today, I only had time to do one example. But in this case, we'll talk a little bit about this quick example. This is probably our most popular request. This is going to be the maximum LTV typically on a one-time close conventional construction loan. So this is going to be a conventional loan, not FHA, not VA, USDA. We have those options obviously as well, but this is a one-time close conventional loan. The rates are a little bit higher than what you saw there for a non-construction loan, but still very good options that we have here for a borrower to lock something in now that they're not going to move into for 12 to 18 months. So obviously there's a little bit of risk there involved for the lenders and the banks that are involved in this. So a little bit higher rates, pretty much a given. But these are great options. This is still the maximum 95 LTV in this case, which is the maximum leverage for most people. You could do 97 if you're a first-time home buyer. And obviously have the high credit. This does require a 700 plus, and in most cases a 740 plus to get the premier terms and the high leverage on the construction loan. So a lot higher bars and hoops to jump through for our borrowers. But again, if they qualify for this, this is a great option. So the rates here, the best rate that we had, there was no zero cost rate just because this is a more expensive loan. So 7.75 rate for 9,500 in discount points. I think that's about 2% there. And the lowest option there with the most buy down was a 7.375 rate for about 13,000 discount points and buy down. And you see over here on the right hand column the final APRs for these examples. So the final APR for this example just in the high sevens. So pretty good option here. And remember, this is a $475,000 loan on a $500,000 end finished product, right? So the appraisal value here, what we're doing the loan on, is the value that we're going to get when the home is done. To do this loan, we're going to have to get an appraisal based on the finished value. So this is an appraiser coming out there and checking out the land, obviously checking out the plans, and doing a appraisal based on what they think that home built as is according to the plans with the budget that you have set aside and that piece of land and that market, and then do an appraisal based on that. So that's based on a $500,000 after finished repair value. And therefore we can get a $475,000 loan amount in that case. So we can loan up to 95% leverage here on these one-time close construction loans. This will require mortgage insurance. So in this case, we had a 700 credit. So the mortgage insurance on this size of loan with the 700 credit in our example, or sorry, 740 credit in our example, was $261 per month. So that was included in the payment. I didn't get a chance to add any taxes or insurance in there since this is a hypothetical property. Obviously, the tax and insurance is a little bit complicated when you're talking about a property that doesn't yet exist, right? So I didn't actually have a good estimate because I can't quickly pull up a property that already exists and get the taxes and insurance estimates for that. So in this case, don't have the full payment, but you see there the mortgage insurance is required is pretty reasonable, just as most conventional is with a high credit score, which is required for most of these one-time close construction programs. So that's basically it. Since I only have one example, obviously we could still do like an 80% LTV with no mortgage insurance. That would be great for our borrowers that do qualify. We can do the FHA, the VA. So the VA can do up to 100% because VA obviously offers 100% financing. So the VA one-time close, great option to go up to 100% financing. Same with USDA, obviously, if you're in a rural eligible area. Let's see, anything else that I forgot on this? It does take about 12 to 24 months, depending. That will change the price too. So most of these typically factor in a 12-month build process. If you need 24 months, super complicated or large home, maybe $1 million plus home, then we might need longer time, and therefore that might affect the rates and costs that you see here. This is just a typical scenario with a typical 12-month build time. I think that's about it. Couple comments in here. Yes, it is a high amount for points. Remember, this is a risky loan because remember, they can't finish the loan until the product is finished, right? So we're basically locking a loan for 12 months. So you imagine the cost of locking a rate lock right now, especially with this volatile market, for 12 months, because essentially we can't do anything with the loan until the property's built, right? So our estimate of the rates and costs based on in 12 months, what are the rates and costs going to be? So this is a very hard loan for us as the lender and for, the investors, the end banks and stuff that set up these products to estimate. So you're very right there, Adam, that these are high points because this is a risky product. And during a lot of volatility, sometimes these products aren't available, right? These are kind of the first products that aren't able to be forecast when there's a lot of volatility because we have to just price it too high where it just won't be a viable product. But right now, with the rates coming down, we're seeing a slow downward trend. These products are very viable right now, even though this seems like a high amount of points there. Adam, remember, this is a custom home. Obviously, someone looking for a custom home is willing to, pay for that. We can obviously fix it in different ways and try to tweak that to be more favorable for the borrower, but it is a higher cost loan for sure. This is a good question. Let me pull this question up from Matthew. So if a borrower owns the land completely, are they able to use that land equity for the down payment and closing costs for a construction to perm? Yes. So we could do this as a construction to perm refi, still one-time close. So that would be typically a kind of a refi version of it, right? So if they already own the land free and clear, we can include that into the down payment and structure it up. Many times our investors already own the land. So that's a very typical scenario when we're talking about our fix and flip type ground up construction for investors. But it's also a common scenario where a primary home borrower may have already bought the lot and have just been sitting, waiting to get their plans built, et cetera. Because remember, we have to purchase a lot and we have to have the plans ready, right? We can't start the loan until we have the lot picked out. We have a contract on the lot because that's the property, right? That's the purchase contract, even though it's not built yet. Then we have to have the plans in place to start that loan and kick that off. So it is common, as you're saying there, Matthew, for a lot of people to buy the property first, the lot, and then we can work that in as their down payment and closing costs. So you're exactly right there. And a lot of comments here. Appreciate everybody tuning in. I don't see any other questions, though. So I think we can go ahead and wrap it up if you want to, Con.
Yeah, absolutely. Thank you. So great program there. Something to take advantage of. If you are looking to do this or any other product, as you saw when Nick went through, we have everything from conventional FHA, USDA, VA, all the way to things like this one-time construction close, and even further to DSCR, fix and flip, ground up construction, commercial. We essentially do it all here. And our loan officers here at the Mortgage Calculator are consultants that can walk you through the process of these more complicated type loans like Nick just went over. So if you would like to be paired up with one of our loan officers, go ahead and visit us at themortgagecalculator.com. We can pair you up with one of them. We have over 300 loan officers. We are licensed in 22 states across the country, and the business purpose loans and commercial loans we can do in almost every state. So visit us at themortgagecalculator.com. And we do this show every single weekday at 11 a.m. Eastern. We go through the live rates, and then we pull up a deep dive into a topic just like we did today with the one-time close construction loans. So thank you, Nick. Appreciate it. Thank you, everyone, for tuning in. And we hope to see you all tomorrow at 11 a.m. Eastern time for the next show. Take care.
Thanks all.